Good day, everyone, and welcome to our webinar on doing business in the USA today. My name is Veronica. I'm from Accace, and I will be your moderator for the day. I'm happy to announce that this webinar is brought to you by Accace and Hydra Consulting. And today we will be talking about some interesting topics about doing business in the USA from the perspective of European investors. As for the agenda, we will walk you through the whys and whens when it comes to doing business in the US. We will also deep dive into the opportunities, risks, and common pitfalls. And we will also explore the tax aspects of the US investment from the perspective of your country's legislation. We will make sure also to share some practical tips and real-life examples and end the whole session with some valuable questions and answers. So during the webinar, feel free to submit your questions, of course. I would like to introduce also our speakers, Petr Neškrabal from Accace and Joseph Sharpen from Hydra Consulting. Now, again, as I mentioned, throughout the webinar, feel free to submit your questions. If you see this icon, then just click on it and ask whatever you want to. While we are waiting for all the attendees to tune in, I would like to briefly introduce Accace, and then Joseph will also briefly introduce their own company. So if you're not familiar with Accace yet, we are a proactive consultancy and outsourcing partner with the main focus to bring smart and streamlined technology and all-round care to our clients. We have experience with various industries, business sizes, and we are operating globally thanks to our Accace Circle business community. Currently, we cover more than 60 jurisdictions, and we engage 7,000 professionals. Our clients, totaling around 80,000, come mostly from Fortune 500 companies. Now, what we do on a daily basis is, of course, advisory and BPO services, but altogether, we have vast experience with helping companies entering new markets or expanding to different jurisdictions. As for advisory, we specialize in tax advisory, tax compliance, also transaction advisory such as due diligence, mergers, acquisitions, transfer pricing. And we also provide legal advisory either with our legal experts or through our full-fledged law offices across Europe. We also provide corporate and secretarial services covering the whole process of forming a company, including market entry support, go-to-market consulting, and virtual office and such. As for BPO services, we focus on accounting, mainly when it comes to automations, technology, compliance, bookkeeping, reporting. And we also provide payroll and HR services where we do payroll processing, calculations, labor law, HR administration, time and attendance. And we really try to bring technology to our clients through payroll, HR, and accounting services. Now, without further ado, I would like to pass the word to Joseph, who will introduce briefly Hydra Consulting, and he will also start a brief overview about the US market. So Joseph, the stage is yours.
Well, thank you very much, Veronica, for the introduction. My name is Joseph Sharpen, and I'm the CEO of Hydra Consulting that was established in 2017. And we are proud to be members of the global Accace Circle and helping European companies mostly enter the US market. We do all kinds of back office services. Well, across industries, we have experience with many industries, which makes our work super interesting because like every client is different and especially like in regulatory environments, industries are very different, so it makes it interesting. And but mostly we do back office services, meaning the boring legal and tax paperwork. So we usually help companies. We start with like forming entity in the United States. Then we help owners with immigration questions as well. So if any of the owners or their essential employees want to relocate to the United States, we provide like relocation services. And then obviously when the companies like start really working in the US. We do like full tax and accounting support, and of course human resources and entire back office, so communication with your employees. And we also outsource sales. So if the companies actually don't have anyone that would sell their services in the United States, we are happy to take that on as well. uh, but we are a small boutique consultancy firm, so all of our clients are not just numbers to us. So we try to have like a long-term personal relationship with all the business owners that we work with. Maybe I'll start with a little trivia that's not really known in Europe. Today is Thanksgiving in the United States, which is one of the biggest holidays of the year. So after the webinar, we will all dive into turkeys and Thanksgiving Day parades. You are, obviously it's not really a big thing in Europe, but in the United States, it's a good trivia to know for sure. So if you are writing to somebody, if you wrote to somebody this week and they didn't get back to you, this is probably why. And I don't really have a control over the presentation, so I will be asking Veronica to help me advance the slides. And we will start with like a brief technical overview of the U.S. market, and we will get into types of companies that foreign owners can actually set up in the United States. Uh, the choice is usually between C corporations and LLC, which stands for a limited liability company. There are other types of entities like LLPs and S corporations, but S corporations actually cannot be owned by non-American owners. So the choice is usually between C corp and LLC. The C corps are most common. They basically behave internally like joint stock companies in Europe. And in terms of taxation, they are subject to federal tax rate of 21% and sometimes applicable state taxes. The state taxes are different. Like most of the states in the United States, they actually have uh, a set tax rate for C corps, but some of the states actually don't have taxes per se, but they have a gross receipt tax, which can be sometimes advantageous, and sometimes it can hurt companies because you are actually paying like really small tax on your revenue instead of a flat rate tax on your profits. But the C corps are most common for anyone entering the U.S. market. LLCs behave a little differently. They actually have so-called members. It's basically a partnership most of the time. So the company is owned by either individuals or companies, and it's a pass-through entity, which means that the LLC itself doesn't really pay taxes, and the tax obligation actually passes through onto the owners of the LLC based on their shares. They file a tax return, but it's actually like an informational tax return that it's the 1065 return for partnerships. Uh, but it mostly actually just says it contains like a K1 schedules that shows how much profit each of the members is responsible for. And then all the owners actually file their own tax returns and pay their tax obligations from there. Uh, the common issues that you may run into, especially if you are considering relocating some of the owners to the United States, and the owner wants to become employed by the company based on like US law. You cannot be an employee of your own LLC. C Corp, there is no issue with that, but you cannot be an employee of your LLC. Uh, Another interesting thing that we run into quite often, and sometimes actually even like a lot of accounting firms in the United States, like smaller accounting firms, they don't really have much experience with foreign owners and responsibilities of the tax forms and the different implications that it has. And one of the overlooked sometimes things is Form 5472, which basically shows money flow between the US entity and related foreign entities, which can be either physical people, physical persons, or companies. And it basically shows the IRS how much money or how much revenue of the US entity is going abroad, which of course is very important because they are looking for companies that might be evading tax obligations in the United States, and Peter will talk about it later in terms of like transfer pricing and stuff like that. And there are significant penalties for not filing the 5472. They can be up to $25,000 per quarter when it's late. If you have a U.S. entity, make sure that your tax return contains this 5472 form. Another issue that we run into is if the companies that are entering the market are considering taking on any sort of investors, definitely go for C Corp and definitely go for Delaware C Corp. You hear Delaware a lot, but it's not really because of tax issues. Although, like Delaware is business friendly state, it is mostly because the companies are not established under U.S. law, but they are established under individual state law, and Delaware has the most reliable and predictable law in terms of how the companies are behaving. So actually, most of the companies that are looking for investors, the investors in the US won't even look for anything else than a C Corp in Delaware. And we can go ahead and get into a next slide, which will talk about taxes and how it relates back to the types of entities that I just talked about. So there is obviously a federal tax for C Corps. It's pretty standard and simple. There is a flat federal tax rate of 21%. And for LLCs, they can obviously opt to be taxed as a C Corp as well, while internally still staying, internally still being a limited liability company. But if it's a partnership or a disregarded entity, a single member LLC, they actually are mostly, if it's physical persons, they are subject to a progressive federal tax rate. And you can see on the right-hand side how progressive the system is. And you see that actually the top bracket is really high. It's like 37%. So somewhere about, I would say, $200,000 or $300,000 in profit, it actually makes sense for the LLC not to be taxed on an individual level, but actually convert it to a C Corp. Because if you make a lot of money, you will end up paying a lot of federal taxes. State taxes, I spoke about it briefly in terms of C corporations. Uh, they have different names and different forms in different states, but usually you can expect to pay somewhere between 2.5% and 13% of your income, of your corporate income, that is. And at that point, it really makes sense to kind of look for a business-friendly states that don't have like super high corporate taxes. The common suspects for doing business in the US, like New York or California, are actually states with a super high corporate tax rates. So while being super important, like tech hubs and financial hubs, they are not really the best states to incorporate in. If I would have to suggest, look for business-friendly states, and the landscape has been changing for the past, like, let's say 10 years. A lot of the companies, and you may have noticed in the news or something, that a lot of the companies are moving from California to either Texas or North Carolina, that have very, very friendly taxes for corporations. Uh, Sometimes you will also run into so-called local taxes, and that is just something that local authorities slap on top of the state tax. So you may have, different local taxes in each state. And we will get into that. We are still talking about income taxes, and we will get into this, like, differentiations, like granular local differentiation in terms of sales tax, which I think is the next slide. Yeah, so this is sales tax, and you probably know VAT tax in Europe. That is mostly, at least to my knowledge, and Peter might correct me later, is pretty harmonized across all the EU countries. In the United States, it's really not that way. You have 50 states, and 6 of the states don't have any sales tax. And then there are 44 different legal frameworks on how sales tax work. Uh, and one of the significant difference between VAT and sales tax is actually that sales tax doesn't apply to services. So it applies to all physical goods. And as the landscape has been evolving, because most of the sales tax laws have been written in like 1950s and 1960s, and there was no such thing as internet, and people really didn't foresee actually even domestic companies doing business across the United States. Up until, like, really, it was what, 1930s, 1940s, companies actually couldn't do business outside of their home state. So if you were actually established in California, like, the law was practically saying, well, you will be in California selling to Californians, and that is pretty much it. And as the landscape has been evolving, and especially with sellers on marketplaces like Amazon, and also like a proliferance of software as a service and platform as a service, software services. So some of the states started to catch on. And so now you are in a landscape where basically uh, approximately like half of the state's taxes software as a service, and half of the states don't. Some of the states even like differentiate between the end owner of the software, which may be, if it's a corporation, you are subject to sales tax, and if it's for personal use, you are not. So the landscape is very, very granular and difficult to navigate. Nowadays, we have softwares for it, and I don't really know how people did it in 1990s, let's say, when the softwares were not a thing. Uh, because obviously you pay sales tax only where you are incorporated or you have a physical nexus, which means you have an office, employees, or warehouses. And then later on, as the states starting to catch up to the changing landscape, and more businesses doing business nationally, uh, there is something that developed that was developed, and it's called economic nexus, which means that if your company sells over a certain threshold into a different state, you may become subject to actually collect and remit sales tax in that state. Which makes it, again, a little difficult because you have to look for a past rolling 12 months period and see if you actually cross the threshold and you need to register for sales tax. And it's super super crazy because some of the states they consider in that, let's say, 100,000 threshold, some states consider all of your revenue and some states consider only taxable revenue. uh, so again, if you are selling software as a service, it becomes super difficult because first you have to see if actually the state taxes the SaaS, and if it does, if the state's threshold is uh, is actually subject to all your revenue or just the taxable portion. And it's also super granular on local level. So the states usually have flat sales tax rate, but then every jurisdiction in that state is different. And sometimes even in one city, you can have one business on one street and business across the street, and it's in different local jurisdictions, so the sales tax may vary. Not probably by a lot, but it can be 0.2% or 0.1%. But this is yeah, it's to be frank, it's a mess. So they will most likely have to come up with something, and there are definitely efforts to make it easier for national sellers. So for marketplaces like Amazon or eBay or something like that, it's pretty streamlined, and the marketplaces actually become the collector and remitter of the sales tax, so it makes it easier for the individual sellers. But if you have your own e-shop or you are selling services across the United States, you may end up have to filing like 44 different tax returns every month, which is insane. So there is something called streamlined sales tax, and only 25 states participate in that. So you basically file just one tax return for all these states that you do business in, and that are part of the streamlined sales tax program. So sales tax is super complicated and sometimes difficult to explain because it's completely different than what you are probably used to in Europe. And if we move forward again in the presentation, please. Yeah. So the common question, and I think one of the themes of the webinar that Veronica talked about at the beginning, is like why and when you would actually enter the US market. So most of the time, what we say is you have to really be committed to do that. The US marketplace is super competitive. Uh, and so it actually takes companies usually a long time to grow and mature, unless you are a super hot AI startup. Uh, but it takes definitely time and commitment. So you really have to commit yourself to the expansion. It is not a market where you just go and try and see what happens, because that will be super difficult for you. So you really have to make a really good plan and be committed to it and allow enough time for your company to actually succeed in the competitive marketplace. And especially if your business is B2B, and you probably know that from Europe that the sales cycle in B2B sales cycles in B2B models are usually much longer than the B2C. But B2C has its pitfalls as well. It's a super large market, and the consumers, they don't know your brand, so you may actually spend a lot of money on any sort of advertising and making your brand known in the marketplace. And one of the things that, apart from commitment and time, is definitely money. Because like most of the services in the United States are way more expensive than Europe, and labor is actually more expensive than Europe. So we even have experience with like, let's say, German companies or British companies that are used to high level salaries in their home countries, but still when they come to the United States, it's a little price sticker shock because the labor definitely is more expensive, and it's been uh, especially like over the past 5 years, where the employers were trying to basically catch with the rising inflation. So the salaries went up considerably. And there was a time in 2023, I think, there was a time of changing jobs because, like, I think it was 90% of US workforce actually changed their jobs in that year. Because probably it's in most developed economies, there is a shortage of people practically. So it's really hard to find employees. And in 2023, after the pandemic, it actually kind of came to a head, and yeah, a lot of it was a seller's market pretty much, if you would put it in terms of real estate, where the employees actually knew that they can change their job, and actually ask for more money. So it was a time when it was like super difficult to actually retain people, because and Americans in general are more prone to actually change jobs than their European counterparts. So when they start working for a company, and unless there is a significant progress and promotions, they actually tend to leave and start somewhere else. And they also move a lot for their work, so it's not geographically constrained, like that people only really, if they live in California, that they would only work in California. They are actually willing to move to like the entire other side of the country, to actually, if the job offers is good enough. And if we go to the next slide, yeah, so definitely there are opportunities in the US market, even when, like, in Europe, I guess the perception is a little different due to the current federal administration. But the economy is doing pretty well at the moment. And there are significant opportunities in the market. And one of them, and I think it's similar actually to Europe, but United States is more, I guess, more people actually start businesses in the US than in European Union. So there are significant amount of, like, maybe not large businesses, but small to medium companies uh, that actually have owners of the strong demographic cohort that are closing in on their retirement, and they basically have no one to leave the company to. So there are definitely opportunities if you want to expand. So obviously, like, one of the things is starting from scratch and developing your own company. But there might be really great opportunities in the coming 5 to 10 years where you can actually acquire a company in the US market, which will significantly cut your costs in developing the business and making connections in your industry and stuff like that. Uh, in terms of certain businesses, you may also see an opportunity in cost reduction generally in energy and logistics. So if your manufacturing process is, energy hungry, you may actually consider moving your business to the United States because the costs of energy are much lower than in Europe. And a lot of the businesses actually have been doing that for a while. Uh, because, like, yeah, if you are in manufacturing, your energy costs are probably a big part of your expenses. uh yeah, I talked about it. I hinted to it a little bit, that the US is generally considered to be business friendly, and it's also an American nature to kind of go and start your own company. Obviously, most of the small companies or small startups, they fail. But there is a statistic that actually, like, 95% of Americans owned their own business at some point in some point of their lives. So Americans are very entrepreneurial, and also the market is willing, because it's super competitive. So it's very willing to try new technologies and explore new avenues that the European companies sometimes bring to the market. And yeah, so especially like high-tech companies, in Europe, it might be hard to sell them, even considering like B2B services. But in the United States, like a lot of the companies will actually try that and see if that works for them, which is a significant opportunity for high-tech European companies. And obviously, liquidity. It's not really the size of the marketplace, but it's the amount of capital that's available for funding businesses. So US is by far like the largest, capital market in the world. I think it's around like $16 trillion at this point, and like the second largest, I believe, is China with like 4. And yeah, if you look at individual like European countries, I think UK is the largest in Europe, and it's about like $1.5 trillion, so maybe 2 trillion. So it's like 1/8 of the US market. So there is a big opportunity for fast growing companies to actually look for investors, and either in public markets, and there is also a huge like private equity market in the United States, where investors are looking for the next big thing. And it's much more common to actually spend a lot of money on startups and financing uh, in the US than in Europe. And one of the things actually ties back to the public capital market, because if your company IPOs in Europe, it's very limited actually to where the company can grow. So the investors know that if their startup that they finance will IPO at some point, that it can be huge windfall for everyone involved. And I think my last slide is, on the other hand, talking about risks and pitfalls. So I talked about that in terms of what you need and when to expand to the US. Commitment, time, and money. So you really need to make a serious plan to prevent running out of either of those. So, you have to know that it will take time and money to actually succeed in the US, but obviously the risk and reward ratio is pretty good, depending on your industry. Trade barriers, I hinted to it before, and I think like the perception in Europe is that US all of a sudden with a new administration became like a business adverse place that actually hates all foreign companies that are coming to the US, and it's not really true. We work a lot in immigration landscape in terms of like a business owner, so it's obviously very different from any type of other personal immigration situation. But in terms of business, the US is actually wide open to people that are willing to spend money here. So, but which sounds like very bad, but it's true. And it actually helps European companies and foreign companies to come to the US and do business. So even with the tariffs, and nobody really knows what's going to happen, and that the situation, especially in April and May of this year, has been like super volatile, and everybody was asking like, what do you think about the tariff situation? And we're like, yeah, we don't know. Because on Monday it might be that way, and on Friday it might be completely different. But we've seen in the past months that the situation stabilized a little bit. So there are definitely some trade barriers and tariffs involved, which may, depending on your industry, it may affect your profitability. But yeah, it's kind of stable for right now, and obviously the world would be a great place if there were no trade barriers ever anywhere. But yeah, even if you look at Europe, the trade barriers for foreign entities that want to enter the European market are super high, and it might not always be uh, you know, uh, like tariff barriers, but non-tariff barriers as well, in terms of like regulations and stuff like that. So unfortunately, it's part of doing business, and unfortunately, this year we've been subject to super high volatility and uncertainty in terms of where the market's going with that. Yeah, and I spoke about it too. US is really not a place to just go and try and see what happens. You really need a good plan to come and uh, really commit yourself to expanding, because it's a completely different marketplace, and the mindset of companies here is also very different. So you definitely need to consider that when trying to expand to the US. And yeah, doing the same thing. That's also a common pitfalls for a lot of foreign companies. So what may work for you for your business in terms of like a sales channels and marketing and stuff like that in Europe or any other part of the world might not necessarily be directly translatable to the US. So you definitely need to think about the market as such and how different it is, and how to maybe adjust your business model actually. And one of the things that also need to be adjusted quite often is your pricing structure, especially like in B2B segments. The companies actually spend more money here on services in absolute terms than I guess anywhere else in the world. So if you are selling something in Europe for certain price, you may want to think about like at least doubling it. Uh, so that also takes quite an adjustment. So it's a different market, and you need to be prepared to make some changes and be actually flexible in terms of your business model and sales and operations to really be successful here. And I think that actually ends my part. Yeah. So I will thank you very much for listening to my rant about the U.S. market, and I will give back floor to Veronica and Peter.
Thank you so much, Joseph. So Peter, whenever you're ready, you are in control of the slides and you can start your presentation.
Super. So, hello everyone. My name again is Petr Neškrábal, and I'm responsible in Accace for coordination of advisory, meaning tax and legal services in our group. And investing in US is some kind of hobby for me, so I know also many things about the US as such. But I think that Joseph told you some important facts about US as such, about taxation, corporate issues. So let me summarize you 6 areas which I picked up, which I believe that are important for investors, yes, from tax point of view. So first area is tax transparency. Joseph already mentioned this to a certain extent. Let me just summarize and a bit expand on this topic. In general, what does tax transparency mean? If you have entity which is considered tax transparent, it means that such entity doesn't pay corporate income tax, whatever you can name it, like federal tax, state tax, and so on, itself. However, this tax base or income is transferred to the shareholders, no matter whether it's paid or not. Simply in the year you have a profit, you already transfer this profit to the shareholders, and the shareholders taxed this profit on their own. Yes, and what is important, if you have a real life situation that you have, let's say, investor from Czech Republic in the US. And in the US, you have a tax transparent company. So if the US entity meets some criteria, generally it's some kind of, you do operations which is related to the US in very, very simple, let's say, explanation. So if you meet the criteria, it's not the US entity, however, the Czech shareholder, which is obliged to register in the US for taxation and is paying the tax from this income. So this is generally implications from the US point of view. From the, let's say, investors' tax point of view, good thing is that in the most, and I think that in maybe even in all European countries, I mean EU countries, there is already known concept of tax transparency. So usually the taxpayers in these countries which are paying tax from this transparent investment in the US, they can credit the tax base in the US in their home country. So in their home country, they have a tax base from their own activities. They will add tax base from their investment in the US in the transparent entity. They calculate the tax and credit the US tax against this tax on total income. So this is the standard concept. In the US, the most common tax transparent company for us, as Josef mentioned, are LLCs. What is important to say, when you register LLC, you can decide whether this entity will be considered tax transparent or not. What is important to say, if you do not think it's tax transparent, yes, because it's originally intended to be tax transparent. So these are LLCs, and then you have these S corps, which are, as you mentioned, not option for us, and that limited liability partnerships, which are also transparent, and they have some special regime. So for legal entities, it's in the end quite similar to the individuals. They will add up the tax base, they will credit the foreign tax. There are some limits, and then the remaining amount of tax is simply due in the country of investment. So this is for tax transparency. I will move on to other area. This is the other area I picked up is limitation of benefit clause. It seems to be quite sophisticated, and maybe some people think that they don't need to know when they are doing investment in the US, but it's very, very important, and it can have impact, which is basically making the whole investment in the US quite tax non-efficient. So please take this into consideration. What is limitation of benefit clause? This is the clause in the tax treaties which are concluded with the US. It's unique. Usually in no other tax treaties you can find it, just with the treaties with the US. And purpose of this clause is to prevent from abusing the tax treaties with the countries. And how does it work? You have some kind of test, and you have various options you can meet, and it's sufficient to meet one of the options, and if you meet them, you are liable to or allowed to use these benefits from the tax treaty. If you do not meet any simply you cannot use the tax treaty. And I picked up 3. There are much more, but usually the rest is for financial institutions, government, non-profit organizations, companies which are traded. I picked up these 3, which are quite standard for at least my real life experience, which I had. First test is if you are individual. If you are individual resident in the country, you are automatically considered to be allowed to use benefits of the tax treaty. The second option is if you do active business. So if you have corporation in, let's say, European country, you are doing active business, then you are entitled to use the benefits of the treaty. What is important to say here that if you are holding company, even if you have team and you have premises and you are doing just administration of the shares, then you are not considered to do active business, and standardly you are not allowed to this limitation of to benefits of the tax treaty. And there is last test, which is saying it's enough to that, if not you, that at least 50% of your shareholders meet the criteria above. So if you have a holding company, for example, which is having more than 50% of individuals which are resident in the same country, so the holding is meeting this benefit or limitation of benefit clause and are liable to the benefits of the tax treaty. So these are the three tests, and where it has impact and where it's really important for all of you. If you have these holding companies, or you can have some company which is having mainly passive income, like income from licenses or from financing. And if these entities have majority of shareholders foreigners or foreign entities, in this case, you wouldn't meet this limitation of benefit clause, and you wouldn't be allowed to treaty benefit. Yes, and if you can imagine, I will speak about this later, but if you are holding which wouldn't meet this limitation of benefit clause, for example, there will be, I don't know, it will be Czech holding having one Polish shareholder, one Slovak shareholder, and one Czech shareholder, each will have 1/3, yes, and this holding will have investment in the US, then the holding wouldn't meet this criteria. And the US entity, when paying dividends, instead of 5%, which would be standard reduced rates based on the treaty, there would be 30% withholding tax in the US. So it has really quite significant impact. What is important to stress that the limitation of benefit clause in the tax treaties is not the same everywhere. And there are 4 countries, at least I'm aware of, in EU, which do not have this limitation of benefit clause at all. And those are the countries mentioned here: Greece, Hungary, Poland, and Romania. So with them, if you have holding and so on, and you have substance there, it's not the case about which I spoke. With the others, it's irrelevant. Third area I would like to speak is dual tax resident companies and some kind of tiebreaker rules in these cases. What is dual tax resident company? Is the company which is having in one country residency because of the seat of the company, and in the other country it's tax resident because the company is managed from that country. And basically, this country is dual resident because it's locally considered resident in 2 countries. And in the tax treaties, you have some kind of rules. We call it tiebreaker rules, which are saying if you are resident in both countries, where you are in the end resident. Yes, and in majority of cases, I would say, if we disregard US, so currently in a real majority cases, you have this tiebreaker rule saying that if you are resident in both countries, you are tax resident for treaty purposes in the country where you have effective place of management. So what does it mean? If we have German investor in the Czech Republic and German holding will establish Czech entity, and the entity will have German managers, and basically they will be sitting in Germany, if I say extreme case. So then German tax authorities can come and say the Czech entity is effectively managed from Germany, so we are going to tax this entity in Germany. And this is based on the Czech-Germany tax treaty. On the other hand, the treaties with the US are different. Yes, they do not have this place of effective management concept. They have a different concept, which is different treaty to treaty, and basically it's following some kind of development of US model treaty based on which the treaties are negotiated by the US. The most old ones, if you have company resident in both states, are saying that in this case, it depends where you have state of incorporation. Meaning that if you have Czech investor in the US, so if the US entity is based on the US law, which you can expect, then no matter where you have effective management, you are always tax resident in the US, which is quite good. And I put here some examples. It's Czech Republic, Poland, Romania, for example. Yes. Then in other treaties, which are the newer one, they are saying in case you are tax resident in both countries, is decisive how the tax authorities will agree. So you have some kind of mutual agreement procedure, which is, for example, case of Slovakia, Germany, UK. And what is usually mentioned further, if the tax authorities do not come to the agreement, then you have no treaty benefit. Yes. So if you are in a complex situation and they have no agreement, you cannot utilize tax treaty benefits. And in the newest US model, which I don't know where is applicable as such, but there is no mutual agreement, there is no state of incorporation. It's simply saying, if you are tax resident in both countries, you have no entitlement to treaty benefit. Yes, so it's even stricter, but it will be most likely used in the newly negotiated or renegotiated treaties. But currently, I haven't seen this in reality alone. It's usually added to this mutual agreement or disagreement in the end. And why I'm saying that. It has impact, especially in case of this first group, because usually if you have some company abroad, which is, I would say, naturally based on your system of the management of the subsidiaries managed from your home country, then you are still having some kind of problem how to do the management locally in order the place of effective management issue will not arise. Yes, and here with the US, if you are the first category, then you don't need to take care about this. You can have US entity, you can have management from your home country, and you don't need to be worried about that your home country would say, this entity we want to tax, and simply we will apply this place of effective management rule. I already partially mentioned the next topic, which is topic of dividends. If we are having situation, we have US company paying dividend to let's say investor to the in the EU. What does it mean? First, you must have a look whether the US entity is tax transparent or not. If the company is tax transparent, so as we discussed before, you don't need to wait for the date of distribution of dividend. There are specific US rules which are saying the company is being taxed based on this income of tax transparent entity. And there is also, in some cases, a deemed dividend concept that US is taxing not only income based on federal and state tax, but also there is some kind of deemed dividend. So this is for non-transparent. Now let's coming to tax transparent and tax. I'm sorry. That what I mentioned was for tax transparent companies, and now speaking about tax non-transparent companies. If you have no treaty, for example, you cannot benefit from treaty benefits, then there is withholding tax on dividends 30% in the US. And the wording of the treaties are quite standard. Usually, the withholding tax limited by the tax treaty is limited to 5% in case of legal entities owning at least 10% share in the US entity. Then it's 5%. If you do not meet this 10% limit, then the withholding tax is 15%. Usually in the home country receiving dividends, you either have some kind of exemption based on the local rules, or you tax the dividend, let's say, again, but you can credit the US tax from your tax, local one. For individuals, if you can benefit from the tax treaty, then the withholding tax is in all cases 15%. And again, you can have exemption based on local rules. If you don't have exemption, you can utilize the tax credit. And I have here last slide on which I have another remaining two topics. First topic is capital gain. I would like to speak about situation that you have European investor in the US entity, and European investor is selling the shares in the US entity to another investor. And what is the tax implication in the US? Yes. If you are allowed to utilize treaty benefits, and the company is tax non-transparent, the company which is being transferred, then as a standard rules, US do not have rights to tax this income. Meaning that if Czech entity is selling shares in the US entity, income from this sale wouldn't be taxable in the US. There is one exception, and it is so-called real estate entity. If you have US entity which is owning at least 50% of asset value real estate, yes, in this case, it is considered as so-called real estate entity. And in this specific case, US is allowed to tax this income from the sale of such entity. And this is the rule in the tax treaties I have found, and I think that it's quite common. It's different if the entity is non-transparent, that you are basically selling the assets in the US, so the US would be taxing this income. And obviously, you need to also have a look at your local legislation. What are the rules for various exemptions? Because in many countries, the income from the sale of shares are exempt, not only in the US, from the perspective of the company being transferred, but also from the perspective of the country where the investor is being resident. So this was for the capital gains. And last topic, transfer pricing. What is positive that in the US, they have the same, I would say, understanding of transfer pricing rules as we understand in EU, and it's following OECD transfer pricing guidelines. So what we can recommend, if you are at the beginning of the investment, please plan the price stipulation for the transactions between the US entity and other entities in your group. Prepare first pricing following OECD guideline, then prepare documentation, and you will be safe in the US. You must be ready if you have bigger transactions that US tax authorities will check. And obviously, if they see that the margin in the US is small, they want to make sure that you are not transferring the US profits abroad. So for this, really documentation is highly recommended. And just to do small marketing, we are ready to prepare documentation for you. We have also access to US databases. So depending on the situation, we can also do benchmarking for the US market. So we can help you with the pricing as well as with the following documentation, which would meet the US requirements. So that's from my side.
Thank you so much, Peter, for your valuable input. We are actually up with time. However, we do have some questions from the audience. So if anyone can stay a little bit longer to hear the answers, that would be absolutely fantastic. I will bridge through to the Q&A session, of course. And I will ask the first question from our audience. I need to figure out who of you has to answer it, so please feel free to speak up, both of you. But one of our attendees is asking that if you have a LLC, limited liability company in the US, and a single member in the United Arab Emirates, does that mean that the income from the American LLC will flow through to the UAE, and it will be subject to the tax there in accordance to the UAE rules?
I know I cannot say the specific rules, but I know that it depends on the type of income which is US entity generating. That if the US entity is generating income which is not meeting to be somehow related to the US. Yes. So if you have no employees in the US, no offices, no customers, and so on, but there are some. It's really depending. But this is, I would say, just some kind of concept. Then yes, if you are related to the US based on the US legislation, then this the LLC wouldn't be taxed in the US, but the partner would be taxed in the US.
I see.
The most common thing that we see, especially with people owning partnerships or single member LLCs, is practically the LLC in single members doesn't file taxes, but the person, if he is a tax resident of UAE, basically has to file 1040 NR, a non-resident tax return. And actually, if it has what Peter was talking about is income effectively connected US income, meaning you have any customers and you basically are operating company in the United States, then the single member has to file 1040 NR and then basically add that tax return to the tax return in your home country, which in this case would be UAE. And based on the tax treaties, you are usually not subject to additional tax. However, if the taxation on that income would be higher in your home country than in the US, you will just pay the difference. So that's the most common case, unless you are somehow exempted, and that's what Peter was talking about.
Thank you so much for the answer. There is another question. Can you elaborate on the limited liability company foreign owner structure? I want to understand the taxation at the level of the investor abroad. What are the tax obligations of the foreign investor in the US, if any?
So I think that this is the same question as before. That it depends whether the company will meet this, I would say, business relationship with the US or not. And based on this criteria, it's decided whether the partner should or should not be liable to taxation in the US.
Joseph, would you like to add anything to that?
Yeah, it's really the same. You would have to get into details. If it's an active US company doing business in the United States, it's taxable in the United States.
I see. Thank you so much for answering. We have another question from the audience. And the question is it possible to register a fintech startup like Web3 cross-border payment application with neobank from Delaware and do the crowdfunding on WeFunder? I think the question is quite tricky because it's not really related to taxation, but
yeah, it would be more about like banking. We actually had a client that used to or their business model was basically crowdfunding. And yeah, so it's definitely possible. The only thing that you will run into most likely is opening a bank account, which becomes more and more difficult with progressing regulation. So there are only very few banks that will actually allow opening a business account for foreign owners. There are several of them. Feel free to reach out to us if you need any specifics. But yeah, you may run into problems with basically opening a bank account. But if you are a US-based company, you can actually participate in the crowdfunding platforms.
Thank you so much for answering. And that is so far all from the audience. Maybe I will just ask just some additional questions to clarify, because Joseph, you were saying that there are federal tax, state tax, and also local taxes in the US. Now, from me, a person from Europe, that sounds extremely complex. And I wonder, are the deadlines matching? How easy it is to administer? What is your take on that?
Yeah, it sounds daunting, and it probably was when everything was done manually. But nowadays, fortunately, you have so many softwares, and yeah, to your point, yes, the tax deadlines usually match. So for C corporations, it's actually April 15th. And for partnerships, so LLCs that are taxed as partnerships, the deadline is actually earlier. It's March 15th.
I see. Thank you so much for clarifying that. And last question from my side, actually, to you, Peter. So if you were a company in Europe ready to expand to the US, and it was your company, what would be the first steps you would take?
I think that I'm a bit different from, let's say, a tax point of view, but definitely I think that the most important thing is the location of the investment in the US, because it's quite complex. Yes, on one side there are better states from the taxation point of view, or not. On the other side, business first. Yes, it's nice that you do not pay taxes or pay just federal tax, but in the end, if you do not have income, then it doesn't help so much. So I think that the first thing is to choose location. Obviously, partner in the US. Good is if you choose also partner in Czech Republic, and basically you have some kind of discussion how to structure the business, and then you need to decide who will be the investor, whether it will be holding, some operating company, the individual, and then from tax point of view, as I mentioned before, you need to set up the prices, because it's quite common at the beginning that you have a US entity basically primarily for the purpose to get access to the market. And you don't have such a big infrastructure in the US. So it's like that you either sell from Europe goods or services to the US entity, and the entity is just reselling these products to the customers. And then usually you need to put there just small margin on the US entity level, which is being taxed in the US. And then you need to somehow document this, because for US tax authorities, they can say, why we have here only such a small margin. On the other hand, in the investor state, they can say why there is even that margin if the entity is doing nothing. Yes, so you need to document, because everybody can fight for its taxation in the country's investment and investor, and you need to document this. So this is important to set up prices in order you start the business, the flows, and it's already set up. It's always difficult if you do it somehow, you try, and then you change transfer pricing setup, and you should explain not only why it is like this, but why it was like that before, and why you made the change. So these are some tips I have in mind now.
Thank you so much. I think that was extremely valuable, interesting. And actually, that brings us to the end of our session. So I actually want to thank you both for sharing the valuable insights from your experiences and from your day-to-day work. And I also want to thank our attendees for listening throughout the whole hour and asking us the questions. Of course, if anyone has any further questions, or if you would need some help with expansion either to the US or any other markets, do not hesitate to reach out to us. I would like to also highlight that for next year, we have in pipeline more webinars about doing business across various markets. And we also have some planned actually about some other pressing topics, such as the pay transparency in Europe, or the e-invoicing that is going to affect all of the businesses essentially in Europe. So with that being said, I would like to thank you all again. I promise that we will send follow-up materials to everyone who joined, also those who couldn't join us. That means we'll share the presentation as a PDF file and also the recording so that you can watch back. And again, if there are any further questions, we will be at your disposal. So thank you so much for joining us today, and we hope to see you again on some other webinars and events. Have a great day.